Welcome in. Today's discussion is going to surround the Dow Jones Industrial Average and the economy, where we are today, and where we may likely be heading tomorrow. Before we dive in, just wanted to share where I'm located on both TradingView and Twitter. If you like my content, please give me a follow. All of the charts that I provide can be found on TradingView under MiniSham37. And then on Twitter, you can see here it's FSA Sean. This is my profile page right here. As you can see, I'm an avid crypto investor. I post most every day at least some sort of technical analysis or thoughts that are going on either within the economy and or the cryptocurrency markets. So with that, let's get started. Today, what I'm going to do, similar to a couple other videos that I've put out, I'm going to actually do this in reverse order. I'm going to go into the technicals behind the Dow Jones Industrial Average and explain what I'm seeing in the charts and what I have been seeing now for roughly 2 years. I'm then going to go into some thoughts surrounding fundamentals pertaining to the economy. And then I'm going to wrap up with some concluding thoughts that you'll want to stick around for. So with that being said, before we get into the first piece of technical analysis that I have put together, I just wanted to, indicate that in this video, what I'm really striving to do, I'm striving my best, really trying my best job to strike a middle ground between those who don't know anything for the most part when it comes to fundamentals or technical analysis, and those that are experts on both ends of the spectrum. I'm trying to find some sort of middle ground that's engaging for both audiences. I am not an expert in any of these areas. However, I do consider myself to be well educated, and well educated enough that the assertions that I'm providing within this video, I'm confident enough to share from a public perspective. So with that being said, let's get into some of the technicals surrounding the Dow Jones Industrial Average. So the first thing I wanted to highlight here were negative divergences that I was seeing playing out within the Dow Jones back actually in 2000 and I believe 18. So if we head over here, the first chart that I had published on TradingView is back in October of 2019. And so what I was pointing out here and what was concerning for me was I was seeing negative divergences between the price action and our price indicators down below. And let me take a quick second to explain what I mean by that. So as the stock market, or the Dow Jones Industrial Average, was creating higher highs within its price movement, the price indicators such as the MACD and the relative strength index were creating lower highs, right? So you can see the downtrend here in both the MACD and the RSI as the price movement was moving up. And so in technical analysis, that is a leading indicator that tells us we can expect downside price action to come at some point. And so that was very concerning to me. That was something I had seen that led me to possibly conclude, one item that led me to possibly conclude that we were nearing a top. So let's see what the next item is here. So going into our next technical analysis piece, you can see here that I have an Elliott Wave count noted. So one of the other items that I saw within the Dow Jones Industrial Average was I believed what I was seeing was the top of a fifth wave within an Elliott Wave count. An Elliott Wave, very simplistically put, is there are 5 definitive waves within an Elliott Wave analysis that plays out in charts historically. There's a big move up followed by a corrective wave 2 move down. There's a big wave 3 up. Typically wave 3 is the largest, although wave 5 can be as big as wave 3. So there's a huge move up in wave 3, another corrective wave 4 down. And what I thought I had seen was around this area here, it looked like we were topping out at wave 5. We managed to, in my opinion, artificially go a little bit higher up to, again, what I believe to be a wave 5 ultimate top here in the Dow Jones, just shy of 30,000. And so once I saw this candlestick come in here, this is a very bearish candlestick. This is a 1-month view on the Dow Jones Industrial Average. The February candlestick that we began to see, looks like maybe the January one was actually my leading indicator here, but February and January looked pretty bearish when we started the year in 2020. And so when you complete a 5-wave Elliott analysis, what happens next is what's called an ABC correction. And so I had originally drawn out in this chart, it looks like I published this chart back in February. I initially thought we would come down to this level here at the 0.236 fib retracement. If you're not familiar with Fibonacci levels, that's something you're going to have to Google and do a little bit of homework there. I'm not going to go through a Fibonacci exercise, but Fibonacci levels are they've historically been shown to be key levels at which price bottoms out, tops out, good entry and exit points that technicians can use in trading. So I thought we would hit this 0.236 level around 24,000, maybe come up around, it looks like I was saying around 27,000, and ultimately come down to a lower level here that we'll talk about. So I had called a top. I had scaled out and made it publicly known that I was scaling out of the stock market in late 2018 into early 2019. I had seen enough within a few other things that we'll get into within the fundamentals, but I basically felt positive enough while I'm not Nostradamus and I can't predict exactly when things would play out, I felt that any positive move up that we would see once I began scaling out would pale in comparison to the downside that we would ultimately see within a recession. So I was scaling out, like I said, in late 2018, early 2019. And so here I got into some commentary. You can check out, my thoughts at that point back in February, where I felt we were at that point. And so the next technical piece that I wanted to get in was, how I calculated the correction move down that we're ultimately going to see within the Dow Jones. So let's quickly take a look at that. As you can see here, I have a C wave that's bottoming out within this range here. And I believe, let's take a look here. Yeah, this is going to show it a little better. So here, what I'm drawing out here, my personal thoughts at that point was that we would see a correction that was in similar magnitude to what we saw back in the Great Recession. And again, some of my thoughts with that and in terms of why we would see a correction level to a similar extent as we saw in the Great Recession fundamentally has to do with debt levels, whether you're talking about the government's debt or in particular personal debt levels. So again, I'll get into that once we get to fundamentals. But I thought something would play out fundamentally that you would eventually see play out in the charts here. Again, as a technician, my viewpoint is you show me a chart and I'll tell you the story. I think understanding the fundamentals are an extra added value component that you can include in the mix here, but ultimately I'm a technician first, so I look at the chart, that's telling me the story. Understanding fundamentals are a nice side piece to have as well. And so if we look at what sort of correction is drawn here, we're looking at let's just call it 55% correction. Over here, that's very close. This was 54.4, and I'm saying this is 54.9 in the Dow. So I'm calling something similar, and basically I'm highlighting a range, a relative range that we could fall within. And let's see how I calculated that range. So the first thing I did, sorry I'm jumping around here. So the first thing I did was I said, well, again, keeping in mind Fibonacci retracement levels, if we retrace down somewhere in between the 0.618, which is a historic fib retracement level, and the 0.702 fib retracement level, which is another key fib retracement level, that puts us around 15,000 to 13,000. Now, the other interesting thing is within this range, or at least close to it, 14,000, this green thick line here, is a historical area of resistance if we go back here. We actually topped out around there back in 2007 during the Great Recession. 11,600 is another key area of resistance and support if we go back here to prior price action from years ago. And typically what price likes to do is it likes to revisit key levels of price support and resistance. And so what I'm saying essentially is that we could see a correction that could take us anywhere from 15,000 down to 11,600. Now, because of the way that the A wave played out, it was a lot more drastic than I thought it was going to be, and we went so low. The other thing to keep in mind is that the C wave in Elliott Wave is a more severe correction as compared to the A wave. And so I don't think 15,000. I don't think any price drop once we break below 18,000, it'll stop there. It'll stop at 15,000. I think you're looking at a correction that's somewhere between 13,300 and 11,600. I really think that's the price level to watch for. We would be lucky if we stopped at 14,000. I really think we're going to get somewhere around 13 to 11,000. Again, because the A wave was so severe in nature. And I think this chart's just showing you, what that would mean from a percentage down perspective. And so if you look here, a 55 to 60% correction. If you go back again to the Great Recession, this was a 54.4% correction. So looking at a correction that's 55 to 60% is not outrageous by any means. So let's go back here and see what our next technical piece is here. So here I'm speaking to the consumer confidence. This is something I more recently found, and I found something very interesting here. So if we take a look at the consumer confidence index, what I noticed was anytime that we had a drastic drop in consumer confidence, like we saw in May, if we go back to prior historical significant drops in consumer confidence, we've never seen a V-shaped recovery. Let's look at a severe drop that we saw in recent times back in the Great Recession. So you can see that we fell off sharply here down in mid-2008. We made a small recovery and we fell back down where we eventually bottomed in 2009 and then gradually made our recovery up. And so what I could see playing out here, and you can see sort of the same dynamic playing out here again, is the same sort of thing. I mean, I think you can actually sort of feel some of the optimism within the economy that things have begun to reopen, right? So to some degree, even though millions and millions of people are unemployed, there is some confidence that is being displayed within the economy, given the Fed's artificially propping it up with the printing of the money that they've been doing and the reopening of things. People have been locked up. So you could see consumer confidence maybe trickle up here a little, but I could see it further, bottoming it out here. It looks like we could see it further bottom out maybe in early 2021. And again, if you're using this as a leading indicator and you really would anticipate that happening, if it played out similarly back to 2008 and 9, that would mean that we would expect the stock market or the Dow Jones to bottom somewhere in early 2021. And for some of these items that I'm sharing on some of the websites, I'll include those in the description below in the YouTube video, so just make sure to check that out then. So let's get into some of the fundamentals. So kind of coupled with how I was looking at the negative divergences playing out and the Elliott Wave counts, there were also some items fundamentally within the economy that were very alarming to me. So one of the things that I began to do back in 2018 really and 2019, I began to spend a lot more time studying and understanding our monetary policy, how the government operates in terms of our monetary policy, how the economics work. And man, was it eye-opening. So let's just talk about the United States dollar for a moment. One of the most powerful video series out there on YouTube, and I'll include a link, is Mike Maloney's Hidden Secrets of Money. This really goes in depth and gives you a level of appreciation in terms of the history of money, and it gives you an appreciation for the history of the United States dollar. The dollar and I'm calling this fiat currency for a reason. The United States dollar historically used to be 100% backed by gold. The benefit to that is because it was backed by gold, it was backed by something that had a relatively fixed supply. We eventually went to a partial backing of gold. Then we went completely off the gold standard in the 70s. And you can go to the Mike Maloney series on that to better understand that. I've gone through it a few times because it's just very fascinating. So basically, what's happening right now, and what's been happening for the past, roughly 50 years, over close to 50 years, if not 50 years, we literally have a United States dollar that's backed by absolutely nothing but people in power. So I want you to think about that for a second. The supply of dollars that are in existence are completely up to people. There's nothing that backs it. There's nothing finite. There's nothing that that fixes the supply of something. And if we look at the basic rules of economy, of supply and demand, if we were to drastically increase the supply of something, it would drastically reduce the value of that item, right? So it's very concerning to me that the very currency that we use within the United States, and it's the world's reserve currency, is literally, its supply is 100% dictated by people. And they can devalue it at any point like they have been doing recently. A great quote here that I found by Herbert Hoover, former president, was, "We have gold because we cannot trust governments." So think about that for a second. So he was clearly, understanding of the fact that we had to have the United States dollar backed by gold so that we wouldn't have greedy people in power who could devalue it at an alarming rate, which is what's happening today. And so the last point I wanted to hit on is inflation, and we'll get to some charts in a moment. But what's happened under these stressful economic times, during the lockdown period and the massive levels of unemployment, the answer that the Federal Reserve has taken to this is they've essentially done this. They have printed trillions and trillions of dollars. They like to refer to it as quantitative easing. Quantitative easing is literally just a fancy term that means we printed money, we created money. And so what they did is they printed the money and they injected it into the market. And in this case, what's going on right now is they're buying securities and they're artificially propping up the stock market. So they're buying things to help ensure that there isn't a further breakdown within the stock market. That's really what's going on right now. And so where I'm getting at with inflation is what the average person, or what most people, don't understand. And it's no fault to them. I didn't understand all this stuff until I began researching it. But what people don't understand is all the printing of the money that they're doing right now, the currency that they're doing right now, because they have, and maybe I'll just show you the chart here. Let me see here. Let's take a look here. There's a chart that I have. This chart right here just spells it out. So this is 2008 and 2009. Now, as you'll probably recall, during the Great Recession, the government came in and bailed out a lot of companies, and there was a lot of controversy about that. This red line, this represents the amount of quote-unquote quantitative easing. The Federal Reserve likes to use a lot of terminology to make themselves sound fancy. You'll listen to Federal Chairman Powell say that they have a lot of tools in their arsenal. They don't have any tools besides printing money. That's all it is. And quantitative easing is just that. And so what they did in 2008 and 9 was, this spike represents the money that they printed and they injected into the world. This right here represents the current printing of money that the Federal Reserve has done. And you can see the multi-trillion-dollar level of printing that took place here. This pales into comparison to this. Now, the consequence of this is because you've injected that much money into the supply, it's going to ultimately, at this rate, result in hyperinflation. Hyperinflation means that the value of your dollar, because there's so much of it, is going to go down at such an alarming rate. You're going to notice by next year, definitively, two main things you will notice. One, the government will need to tax us in certain ways to pay for this. And two, you will notice that things around you will become more expensive. And it's not because the cost of goods and services has become more expensive. It's because the dollar has devalued. And so the relative value of what you're spending has become less and less and less. You need more of it to pay for the same item. And I hope that makes sense. But again, I would encourage you to visit Mike Maloney's series. I mean, he just does an awesome job. I can't, I would be doing him a disservice if I tried to explain it the way he did. So please visit his, I'll send a link and please visit his series. The other thing I wanted to touch on that I was very aware of when I was looking at these negative divergences was the average bull market length. The average length for a bull market, if you look it up, and I'll provide a link for it here, we're not going to take a look at it, but it's around 5 to 6 years. We were on a trajectory. Take a look at this trajectory right here. I mean, look at what was going on. If you come back here, look at this. When we bottomed in 2009 during the 08-09 Great Recession, this is practically a straight line up. I mean, literally for 11 years, we had upward. There were little corrections here and there. This is not sustainable. A healthy economy has ups and downs, as my father likes to say, ups and downs. You have corrections here and there. You have, weeks and months where we're moving up and down. But I mean, literally, this looks like a straight line up for 11 years. That at some point you need a healthy correction, and unfortunately, the bull market. What was concerning me, along with the relative price weakness that I was explaining earlier with those negative divergences. Coupled with that, I just said, hey, this bull market length has been, we're going on 10 years now. I mean, this is out of the norm, right? So we're going to see a major correction at some point soon. So that was something else alarming. I spoke to the debt levels. The other thing I wanted to hit on here is the debt ceiling. There is no debt ceiling. People in power always vote on quote unquote what the debt ceiling is. I just want to let you know, you can, again, do a little bit of homework here. I think Maloney explains this as well. There is no debt ceiling. I mean, we literally can print as much money as we need and assume as much debt as we need. But at some point when you devalue your currency, the United States dollar, which is the world's reserve currency, when you devalue it to a point where other countries are looking around, they're not going to want to do business with us anymore. They're not going to want to work with the United States and work with the United States dollar if they're looking at it and they're seeing how much we're devaluing it as well. So that's very concerning. The other thing that was leading me to conclude, again, looking at the chart and trying to understand what perhaps the narrative could have been a year and a half ago, I looked at consumer debt levels, and it was very, very alarming to me, extremely alarming. If we go here, this is an article that was published in 2019, and I'll share a link once again. If we look at the debt levels here of the Great Recession, we began topping way out above these levels in mid-2019. And if we take a current snapshot view, this is very telling. This is a current snapshot of total debt, okay, balance. We topped out here in the fourth quarter of 2018, and look at those levels. We have non-housing debt of 2.7 trillion and housing debt of, we'll call it 10 trillion, okay? Flash forward to current times. Our housing debt remains roughly the same, okay? So we're around the same levels that we were back in the fourth quarter of 2018. Look at the non-housing debt. The non-housing debt has far superseded what we were 12 years ago. And that is very concerning to me. And the non-housing debt would consist of things like student loans, auto loans, credit card balances. And now that we're under a very stressful situation where I believe, and don't quote me on this, I believe the current unemployment rate, although they measure unemployment very different today than they did years ago, but the point is the unemployment rate is at least, I believe, as high as it was back during the Great Depression, or it's at least very close to it. So, and now we're in a situation where a lot of people are unemployed. They might need to pay for things they can't afford, and so they're going to be racking up their credit card bills. You also, unfortunately, I didn't have this built in as a talking point, but a quick touch on it, because the government has created a system under which they incent people to remain unemployed. That doesn't help the situation. People can file for unemployment. The government's now handing out checks. We're really entering an area of debatably the greatest level of socialism that we've ever had in this country, which is quite dangerous. And so now you have situations where people are actually receiving checks in an amount that exceeds what they were making when they were employed. Let me tell you something. If I made $30,000 a year and the government was handing me over checks that I was making $50,000 a year, why would I want to get a job? Why would you want to get a job? So it's a real dangerous situation for people that are not incentivized to get back to work and are also increasing their debt levels because they're overspending. And I put the American dream here because I kind of question what that is. The American dream, whenever I hear that, I always hear that's to have a nice house and a nice car and a 4.5 person family. And so the question is, at what cost? I mean, I live in South Florida and I can see the materialism that surrounds me down here. Everybody needs to drive a real nice car, and I question sometimes how people can afford certain things. And it just shows up in the data that I just showed you, that debt levels are just out of control, and it's very, very concerning. Last thing I'll say here is we're under a stressed scenario. And so what I potentially saw playing out, again, before the coronavirus hit, was I saw some sort of event occurring that would cause financial distress, stress on people. They have an extraordinary amount of loans. They have to default on those loans, and it's like a domino effect. And so that was just my educated guess on what might potentially play out. The next thing I have here that's really eye-opening that you should read up on is what fractional reserving is. Now, I'm an actuary by trade, and so I can appreciate the regulations that are in place for insurance companies to ensure that we have enough statutory reserves to meet our future obligations, claim obligations. And did you know that banks are only required to hold a fraction of their obligations? And did you know that that obligation could be as low as 1%? So one of the concerns here is that if banks are not required to hold 100% of their obligations or close to 100% of the obligations, again, something else that is at least food for thought is if every person who does business at a bank went to the bank on the same day and said, "Give me my money. I'd like my money from the bank," they would quickly find out the bank doesn't have your money. They're all digits that you log into on your phone. The bank is literally not holding your money. There were websites out there, I couldn't find them before putting this together, but they actually show the reserve ratios that certain banks have. I mean, 1%, 2%, 5% at most, I saw 6% maybe, of obligations on their books. And that's just maddening to me. I just can't imagine why the reserving requirements are that low. The other extremely concerning thing, and by the way, this seemed to just be a footnote in one of the statements that the Federal Reserve Chairman laid out there back in April. I don't know what month it was, but it was recent. He eliminated the fractional reserve requirement. Now, that literally means that banks are obligated to hold $0 in their bank. So theoretically, you could have a balance of $100 in your checking account, go to the bank to withdraw your $100, and it wouldn't be there. Think about that. Banks are required to have $0 in reserves. I mean, the reason they did that is they want to promote lending. amongst institutions, but that is a recipe for disaster. If banks are obligated to hold no reserves, I can't imagine that we're in that situation. It's very, very, very alarming to me. The repo market was a huge red flag that didn't get enough attention. This was something that played out before the whole COVID situation. The repo market, in short, what was concerning was basically behind closed doors. What happens is banks lend amongst banks. Okay, that's what happens. Bank A lends to Bank B, and and that's critical. That lending that takes place behind scenes of banking institution, it helps the flow of money. It helps the spread of liquidity behind closed doors. It makes sure that all the cogs are moving smoothly and soundly like a machine, right? That these banks can lend between one another. Well, that froze up. Something was going on behind the scenes where certain banks, big institutions, must have been concerned about something because they stopped lending. They would not lend to other banks. So what did the Federal Reserve do? Well, what they always do, seemingly. The Federal Reserve printed money. That's exactly what they did. They printed money and they injected it into the system so these banks could lend to one another. Again, a very concerning situation that I think did not get enough coverage. That the government, again, had to come in and sort of save the repo markets. God knows what would have happened had they not done that. I don't know, but they came in and they just printed money and handed it over to banks. The other thing that I think most people are aware of are yield curves. So what we saw in 2009, and this is basically, again, a leading indicator to tell us more than likely a recession is on the horizon. Back in 2019, we began to see yield curves inverted. Very briefly what that means, because this video is getting extremely long. The yield curves inverted simply means this. It means that people buy up bonds, right? You can buy a 1-year bond, a 5-year bond, a 10-year bond. Those bonds have interest rates associated with them. So basic premise here is if you're buying a longer maturity bond, there's more risk with that, okay? So you would expect for a 10-year bond that would yield a higher rate of return than a 1-year bond. But what began to happen was the maturity dates and the interest rates don't make any sense. Your interest rate on your 1-year bond has a higher rate than your 10-year bond. Okay, and historically, when this sort of wacky dynamic plays out, you can expect a recession to play out. I believe historically it's like 12 to 18 months, I think. Don't quote me on that. It might be as early as 6 months, but I think it's more like 12 months, maybe even 18 months. And then I think this is the last thing I have noted for fundamentals, and that is negative interest rates. So this is an interesting one. Right now we're at 0. I work with a lot of smart people, and I remember this was sort of on the table on a lot. Again, I spend a lot of time early in the morning doing research on the markets. So the discussion of negative interest rates was going on months and months and months ago, and certain channels that I'm subscribed to, had some dialogue surrounding, could the United States turn to negative interest rates? And again, I work with very smart people, and at one point during a meeting, I know I had brought up, I don't know if it was January of 2020 or the end of last year, I said, has anyone looked at how negative interest rates would impact our business? And I work with a lot of people who are more brilliant than I, and there wasn't a single person in that room that even understood what a negative interest rate was. Well, I think we need to be prepared for this, and it's a really scary situation. So I want you to just think of a negative interest rate as most simplistically as this. You have an expectation that when you deposit money at a bank, depending what type of account you have, maybe you have a fee associated with it. But let's take the example of just a savings account. So you have a savings account at a bank, and your expectation is that if you deposit your money at a bank, that you can expect some sort of nominal rate of return. Maybe you're lucky enough to get 0.5%. Okay, so your money's parked there. course, inflation's higher than 0.5%, so you're really losing money. But anyway, you park your money there, so you get some sort of nominal interest rate. What a negative interest rate would imply is that if you have your money sitting at a bank, you'll have to pay them to park it there. Now and I know that sounds crazy, there's other implications as well that you can read about, but we are literally entering a high probabilistic scenario of entering negative interest rate territory, which has never happened before. So just look at all these fundamentals. We're printing money and to trillions and trillions of dollars, increasing the supply of money, which will ultimately result in hyperinflation. Debt levels are out of control for both consumers and government. We've had inverted yield curves, and I don't know what they look like today, and we're entering more than likely negative interest rate territory at some point down the road. So not a great situation right now to be in moving forward. So here are some concluding thoughts I have in terms of moving forward. One of the things, I think the thing that I've struggled with the most in concluding that we are going to have an ultimate C-wave correction in the Dow Jones that will take us somewhere, I'm calling for 13.3 to 11.6, somewhere around 13, 14, 11,000, somewhere in there. One of the biggest struggles I've had with that is that I have an extremely bullish thesis on cryptocurrencies. And so there is absolutely no way I could see the stock market going down 50% from here and cryptocurrencies not seeing some sort of similar volatile movement. Cryptocurrencies are a very risk-on asset. And so anyone who is telling you that we could go down 50% in the stock market from here and cryptocurrencies will respond favorably or neutral is out of their mind or just dead right lying to you. So what I've been trying to wrap my head around is how could this dynamic sort of look between the stock market and cryptocurrencies? And the best way that I can keep my bullish scenario for cryptocurrencies intact and this C wave still corrects would be as follows. One of the scenarios I could see playing out is that the stock market, if we look at a current view on the stock market right now, and there was one other thing I wanted to touch on with the stock market before we get off of this, but I could see the stock market sort of going sideways for several weeks, just sort of petering, maybe staying right around this 200-week simple moving average, okay? So the 200-week simple moving average is at 24,000. I could see us going sideways right around there, whether it's 23,000 or 24,000, 25,000, just right in that range. Meanwhile, while the Dow Jones is going sideways, I could see a scenario, one of two scenarios. Either one, and we'll just talk about Bitcoin since it's essentially the Nike of cryptocurrency and the driver of performance at the moment. I could see Bitcoin moving perhaps up to, breaking above some historical resistance here that I'm watching, and maybe get up to 12,000, 14,000, 15,000. Bitcoin at that point could make a 35% correction. It could correct 35%, which is not atypical for a bull market in cryptocurrency for Bitcoin to correct 35%, given its volatility. We could correct 35% and still look extremely bullish. The stock market might go down at that point if it's at 24,000. It could go down 40 or 50%. So cryptocurrency, maybe you see less of a downside in crypto than you see in the stock market, but you still see significant downside. You still keep the bullish sentiment intact here, and you still see the downside in the stock market. The other scenario I could see being playing out here is that we don't break the descending resistance here in Bitcoin, and we correct down to the mid 5,000 or 6,000 range. That still puts you, I believe, let me see here real quick. So if we went down to like 5,500 and we're at 9,100 right now, that puts us at around a 40% correction. So whether it's a 35 or 40% correction, it still doesn't change the scenario within the larger time frames of the formation I'm looking at within Bitcoin. Stock market still corrects by the same amount. Bitcoin corrects as well. but the bullish thesis is still intact for cryptocurrencies. The other quick thing I wanted to touch on is I would keep a very, very, very close eye on how this month closes out for the Dow Jones Industrial Average, and let me quickly show you why. This is a monthly view of the Dow Jones Industrial Average, and there's nothing bullish about this picture, let me tell you if you're not a technician. One of the key things to keep in mind as a technical analyst is when we look at candlesticks, we call these candlesticks when we look at price action, right? Each candlestick represents a certain amount of time and the price action within that time. The more we zoom out, and in this case a month, the more we zoom out, the more the price action there is that's contained within each single candle. And the more price action that is contained within each single candle lends itself to a more credible view regarding the overall picture of a chart. So as an example, if I zoomed out here and we looked at a 5-minute chart, each candlestick represents 5 minutes. There's not a lot of credibility within the shorter time frames because there's not a lot of data within each of these candlesticks, right? It's only 5 minutes of price action. But if we zoom out, we look at a monthly chart, each candlestick is a month of price action within each candlestick. Well, whatever view this is telling us, it's a very credible view because now we have a much higher time frame with more price action within each candle. This month of June right now, if you look at this candlestick in particular for June, this is an extremely bearish candle. If we cannot manage to get this thing green, if this closes red or it closes where it opened at 25,343, what's going to happen is this candlestick is referred to as a gravestone doji. A gravestone doji indicator is a leading indicator that tells you that price action is about to reverse direction. And as you can see, we had a move up here, right? We had a drastic move down, and then not surprisingly, we had what some were calling a V-shaped recovery. It's not a V-shaped recovery. It's called a dead cat bounce. It's a bounce because we were oversold. So we bounced up, but if this thing closes and it looks anything similar to this, you can expect, it's not going to be right away. I'm not telling you that next month we're going to drop 50%. That's not what I'm saying. But what I'm saying is if this monthly closes anything close to resembling this, you can expect at some point in the next few months we are going to be moving down. I mean, we are absolutely going to be retesting these lows. I can tell you that. So keep an eye this Tuesday to see how June closes. I'm also personally keeping a very close eye on Bitcoin. There are some things you can check out my TradingView profile if you're interested in cryptocurrencies to get my latest monthly view there and my thoughts. But this definitely will, the month of June is a very big month for the stock market that's going to tell us the direction of the way things are going to go. I mean, if somehow we manage to close way up here at 26,000 by Tuesday, that would look good. I still see negative divergences playing out in the chart, and I still don't feel great about it. But it's not as negative as closing out with a gravestone doji. So definitely keep an eye out for that. And so the last concluding thought I had was, with all this money, so basically my current thought right now, and a lot of others who I respect, their thoughts as well, is the government is ultimately artificially propping up the stock market by literally printing dollar bills and buying securities in the market. I mean, that's essentially what they're doing. And so the question I'm asking is, even though they're artificially propping up the stock market, could that result in a higher stock market with no further downside? So what I'm saying is that's possible, but at what cost? Never has there been a time, and I would challenge you to find a time. Never has there been a time where there has been so much divergence between how the economy looks and how the stock market looks and how the Dow Jones Industrial Average looks. The economy is doing piss poor, but somehow the stock market is rallying. I mean, that should be concerning to you. There's something going on there. So if my Elliott Wave count is wrong, which I could be totally wrong about this, and we might go up from here. We might never retest 18,000. We may never go below 18,000. If we go up from here and we go further up than 30,000 on the Dow, I think there is going to be a massive, massive, massive correction at some point 5 to 10 years out. Absolutely. Absolutely, because of all the capital that the Fed has injected into the system. And it's very concerning to me. So we'll see what happens. But it'll be very interesting to see how June closes and then how we sort of close out the year. So with that being said, I will leave you for now. I hope you found this very interesting. And if you enjoyed it, please feel free to share on social media and with friends and family. Thank you.